tax nexus is a connection that gives rise to an obligation for an out-of-state retailer to collect a state sales or use tax. This triggering of a tax collection obligation directly impacts a retailer's tax liability. As a result, sales tax nexus is of particular interest to retailers. The creation of sales tax nexus falls into several categories of activities and circumstances with many variations in specific criteria among the states, such as the nexus created when property is owned, leased, or used in the state, such as a warehouse, office, or distribution facility. The nexus created when catalog sales are made into the state. The nexus created when there are employees or agents soliciting sales in the state. What is known as affiliate nexus, created when there is a related entity in the state that satisfies certain criteria. And what is known as ClickThrough Nexus, which arises from internet sales made as a result of referral agreements with in-state residents. In the past couple of years, there has been a flurry of legislative activity among the states on the click-through and affiliate nexus fronts. Currently, about 30% of the 46 sales tax states, including D.C., have enacted click-through nexus provisions, and about 40% have enacted affiliate nexus provisions. What are commonly known as affiliate nexus laws generally create a rebuttable presumption that an out-of-state retailer has nexus with a state if an entity located in-state is related to the out-of-state retailer in a certain way, such as being component members of a controlled group of corporations, as defined under the Internal Revenue Code, or owning one or the other by specified percentage. For example, New York specifies direct or indirect ownership in either direction of 5%. Earlier versions of laws that created nexus based on a relationship with an in-state entity, laws that are currently still on the books in many states, along with the more recent provisions, are more limited in relationship and provide that an out-of-state retailer has nexus if it has an in-state subsidiary engaging in certain activities or if it has a franchisee or licensee in the state using its trade name. Affiliate nexus provisions often have common elements, such as they create a rebuttable presumption that an out-of-state retailer has nexus if a related entity engages in activities in the state, such as selling a similar line of products as the out-of-state retailer under the same or similar business name, maintaining an office, distribution facility, warehouse, or similar place of business in the state, or using trademarks, service marks, or trade names in the state that are the same or substantially similar to those of the out-of-state retailer, and facilitating the retailer's delivery of sales of property to in-state customers. On the affiliate nexus front, in 2013 and 2014, 5 states had affiliate nexus provisions take effect: Kansas, Maine, Missouri, Virginia, and West Virginia, with Colorado amending its affiliate nexus provision in 2014 in part by specifying the nexus triggering activities engaged in by an in-state entity that is a component member of the control group of corporations of which the out-of-state retailer is a part. Some states had previous unsuccessful attempts to enact affiliate nexus legislation in earlier legislative sessions. Mississippi had an unsuccessful attempt in 2013, and both Hawaii and Indiana had unsuccessful attempts in 2013 and 2014. And although a state may not have an actual affiliate nexus provision on the books, it may enforce affiliate nexus by its policy. Click-through nexus laws, also known as Amazon laws, are more narrow in variation than affiliate nexus provisions and generally create a rebuttable presumption that an out-of-state retailer has nexus with a state if it enters into an agreement with an in-state party that directly or indirectly refers customers to the out-of-state retailer, generally by a link on an internet website, and the agreement requires the out-of-state retailer to pay the in-state party a commission based on sales arising from the referral arrangement. Frequently, there is also a requirement that the gross receipts from sales arising from the arrangement exceed a certain dollar amount during the preceding 12 months. For Georgia, for example, this threshold is $50,000. For New Jersey, California, and Missouri, it's $10,000, whereas in Connecticut, it's $2,000. On the ClickThrough Nexus front, in 2013 and 2014, 5 states had new click-through provisions take effect: Kansas, Maine, Minnesota, Missouri, and New Jersey, with New York withstanding a constitutional challenge to its existing click-through provision. And, as with Affiliate Nexus, although a state may not have an actual click-through nexus provision on the books, it may recognize it through its policy, like Pennsylvania. In the early part of 2015, Maryland, Washington State, and South Carolina introduced click-through nexus legislation. South Carolina was unsuccessful in enacting click-through legislation in 2014. And in 2015, Vermont's governor announced that he will ask the state's legislature to push back the effective date of the state's click-through provision to 1 year after 25 states adopt click-through nexus laws. Currently, Vermont's click-through provision is scheduled to take effect once 15 states adopt click-through nexus provisions that are the same or are similar to those of Vermont. Though click-through nexus provisions are less varied than affiliate nexus provisions, there is some variation in the form that the in-state referral arrangements take. Affiliate nexus provisions, in effect, frequently specify that the referral takes the form of a link on an internet website, and sometimes also by telemarketing or by an in-person oral presentation. An Illinois click-through nexus amendment that took effect in early 2015 presents some variation by specifying that the in-state referral involve promotional codes and other mechanisms that allow out-of-state retailers to track the resulting sales. A non-exclusive list of examples of such mechanisms are links on the in-state party's website, promotional codes distributed through the in-state party's hand-delivered or mailed material, and promotional codes distributed by the in-state party through radio or other broadcast media. The Illinois change was enacted in response to a 2013 Illinois Supreme Court decision in Performance Marketing Association versus Hamer, which held that the state's click-through provision was void and unenforceable as discriminatory under the Internet Tax Freedom Act because it imposed a use tax collection obligation on out-of-state retailers with respect to clickable links, but not with respect to similar performance-based marketing arrangements like those utilizing promotional codes through newspapers or broadcasting. It should be interesting to see if any other states adopt the Illinois language over the traditional link on an internet website language, or adopt any other variation in amending or adopting click-through provisions going forward. Bernita Ferdinand, Wolters, Kluwer, Chicago.